Hey, good morning, everyone. This is Kirk here again at Option Alpha, the members only video update. It is Thursday, December 22nd. Pretty important day for my wife. It's her birthday today. So, gonna be a little bit light on comments and stuff today if we're commenting and emailing back and forth. So, just a little disclosure for everyone. So what I wanted to do this morning quickly is just alert you to a couple things that I saw, and then also give a suggestion of what I'm going to do in my own personal portfolio. This won't necessarily be a trading alert because all of the trading alerts that we have are just one contract, and I keep it simple that way because I don't know what your account position size is. I literally have people who have $1,000 who are signed up, and I have people who are over $1 million who signed up. So that's why I keep the trading alerts at just one contract. That doesn't mean that I'm trading one contract. It means you can scale it up to whatever account size you want. You can trade 50, 100, 200, whatever amount of contracts you want. But when I talk about what I'm going to do in my own portfolio today, and I'm going to start it today and tomorrow, then I just want to let everyone know that it's not necessarily going to be a trading alert, but just a good strategy to have, in my opinion. So, what I first want to start with is just to look at the VIX, as I mentioned in the email. If you look at the VIX, and this is actually January of 2010, where my cursor is right now and where it's highlighting. The VIX has actually been very good at using the acceleration bands as a lower breakout signal. And but what I mean by that is that when the VIX breaks out from these lower end of these acceleration bands I put here on the chart, then really it means that short-term volatility has really hit a bottom and we're going to see higher volatility in the future. So what I don't want to do in that particular situation is I don't want to start really adding a lot of positions to the portfolio, right? If we're going to be option selling with spreads and naked puts and calls, the last thing we want to do is add a lot of positions to the portfolio right now. Hence why the one position that we did add in the beginning of the week was on the top side, right, with that RUT call spread, right? If we're going to add anything to the portfolio, we definitely don't want to add anything on the put side because one, premiums are low, and two, volatility is low and could go higher. So it just doesn't make sense. But I just want to just scale this across and just show you these charts. But you can see that practically every time for the last 2 years now that we've had the VIX break out of these acceleration bands lower, we've had a big move in volatility in the coming days and weeks. So that was back in January, really all through the 2010 mayhem that we had in the middle of the summer. As we get into the latter part of the year, you can see again had a breakout lower and increasing volatility over the next couple weeks. Breakout lower, increasing volatility over the next couple weeks. As we get towards 2011, you can see we really didn't have any breakouts in volatility all this time, right? Nothing that really violated this downward acceleration band limit. And then we get into the end of 2008 here, or 2011 here. And you can see we had a big move down in volatility. Again, breakout, and a couple days later, volatility jumped. A breakout back in October. Again, volatility jumped just a couple days after that. Actually, pretty big move from 25 to almost 37 here. And again, we've had numerous types of mini breakouts, but nothing that closed below that level until just the other day. So now that we've closed below this level, premiums are way down across the board for all options. It means really kind of complacency in the market. People aren't pricing in volatility. They're not buying risk protection, and that's exactly when you should be buying it. So what I suggest that everyone start doing, and what I'm going to start doing, if I go back to my charts here, I'll just look at the IWM. I think the IWM and the SPY are going to be your two best bets going forward. But what I want to do is, again, sell options when there's high volatility and volatility could go lower, and buy options as protection and as a hedge for my portfolio kind of in these times where we've seen volatility now back near 20. We really haven't seen volatility this low in a long time, right? Since really the beginning of August, we haven't seen volatility this low. So it wasn't really useful to buy options because the pricing on options was really, really expensive. But I think right now, as you start to look across the board at what possibly could happen in the next couple of months for the market, we're definitely running into some resistance up here on most of the major indexes we have yet to break out. We still are making lower lows. We are making or lower highs. We are making lower lows, but there's just no momentum. It's just really dried up, no follow through. So if the market does continue to move down the first quarter of next year, I definitely want to be protected now and kind of buy my hedge now instead of buying it when I really need it. So I'm kind of doing this in reverse, but that's why I think it's a good strategy. So if we take the IWM, for example, I like the 55 strike area. Again, you can move it around as much as you like, but I like the 55 strike area, and in particular, I like either February or March contracts. So again, March would be about 85 days from now. February would be about 57 days. Again, it's not that we want these to be profitable. If they end up being profitable with a market, huge move lower in the market, great. But what I want to do with this strategy is I want to buy my protection first, and then I'll feel comfortable about selling options a little bit closer to the market later on because I know I have this protection that's already in place. So it's like buying insurance on your portfolio ahead of it. So I like the 55 strike area. It's a fairly low premium, but it's got a good delta to Vega relationship. I like that. It's got some good volume, and it's not too far out of the money. So again, a major market move. These premiums are going to probably go up to around 100, 120 if we get a move down pretty substantially in the market. If we go out to March, then you can move it down a little bit more because you have some more time. But again, the whole 55 area, so 52s to 53s are really what I like. There's not that much open interest in them right now, again, because people aren't really trading and buying risk. So you can clearly see that most of the activity is going on right near the market. But I think that these are going to be really good contracts if you want to start buying protection for your portfolio heading into the first half of next year. Now, again, when I say that I'm going to start buying this, it's not that I'm going to go out and buy 20% of my portfolio. It's probably going to be about 2 to 3% of the portfolio to use this protection. And again, what I want to do is just get that extra volatility protection while option premiums are low, enter in and lock in those hedges and those risk protections now, so that when volatility does increase, then I can feel more comfortable about selling options. You could easily back leg into these strategies with a credit spread. And so what I mean by that is you sell or you buy this contract now, and then when the market drops, and let's say these 53s go up to $80, then you could sell these at $80 and you'd immediately already have protection at 35. So you'd make a huge spread on the market, and again, you have protection that's working in your favor already. So that's another way to play the market. If you're going to use it with credit spreads, you could back leg into it. And of course, I'll go over those in other video tutorials when the new video platform launches in January here, which is January 1st. So hopefully that's been helpful for you guys. I think that generally where we're at the market is continuing to be this slow grind higher. Futures this morning had a little dip but are continuing to move higher. Let's see if we actually break the 1250 level. That is going to be a major area of resistance. You can see we almost broke it early in the morning yesterday, but just really never got past that level. So it'll be interesting to see if today we break the 1250 level and close above that level. As always, I hope you guys enjoy these videos, and happy trading.